He could become rich by investing in mutual funds. Financial products that were, and indeed are today,
Don't let common investing myths hold you back. Most people believe you need a fortune to start investing, but that's far from the truth. With small steps, you can start building wealth today. Don't miss out on securing your financial future. Start investing smarter, not harder, right now. The clock is ticking, and the earlier you start, the better. Dispelling the wealth barrier myth. Many believe that investing is only for the rich, but that's far from true. In 2023, a study by the National Bureau of Economic Research showed that over 60% of investors started with less than $500. Investing is for everyone, no matter your income. It's about making your money work for you. Starting with small amounts like $50 a month can grow over time, thanks to the power of compound interest. Even if you're on a tight budget, there are low-cost index funds and apps that allow you to invest with just a few dollars. So don't wait until you have a fortune. The best time to start is now. Challenging the conventional wisdom. For years, people have been told that owning a home is the ultimate financial goal. However, recent research challenges this idea. In 2022, a report from the Harvard Joint Center for Housing Studies found that renting can be just as beneficial, depending on your circumstances. While homeownership offers long-term equity, renting provides flexibility and can save money in maintenance costs. In cities with high real estate prices, renting can also be more affordable. It's all about weighing the costs of owning versus renting based on your personal situation. And sometimes, renting might just be the smarter financial move. Unpacking the good versus bad debt debate. Not all debt is created equal, and the idea that all debt is harmful is a common myth. In 2021, research from the Federal Reserve showed that certain types of debt, like mortgages or student loans, can actually be beneficial in building wealth. A mortgage, for instance, helps you build equity in a home, while student loans can lead to higher-paying job opportunities. On the other hand, high-interest debt, like credit cards, can quickly become a burden. The key is managing your debt wisely and differentiating between investments that appreciate and those that drain your resources. It's never too early or too late. It's a common myth that you need to start saving for retirement in your 20s to secure your future. In 2023, a study by Fidelity Investments showed that even starting in your 40s or 50s can lead to a comfortable retirement, as long as you are consistent. The power of compound interest means that every dollar you save today can grow over time, no matter when you begin. The earlier you start, the easier it becomes, but starting later doesn't mean it's too late. Every little bit adds up, so the best time to start saving is always now. Credit cards. A common myth is that carrying a balance on your credit card can improve your credit score, but that's not true. In fact, credit experts like those from Experian emphasize that paying off your credit card balance in full every month is the best way to boost your score. As of 2022, the Consumer Financial Protection Bureau confirmed that carrying a balance actually increases your credit utilization rate, which can hurt your score. Keeping your balance low and making timely payments is the key to a healthy credit score, so avoid the temptation to carry a balance and watch your credit improve. The 4% Rule. Reassessing retirement withdrawal strategies. The 4% rule, which suggests withdrawing 4% of your retirement savings annually, has been a cornerstone of retirement planning for decades. However, recent studies, including one by Morningstar in 2023, show that this rule might not be as reliable as once thought. With longer life expectancies and market volatility, some experts now recommend a more flexible approach, adjusting withdrawals based on market performance. In some cases, withdrawing 3% or even 5% may be more suitable depending on your financial situation. The key takeaway is that retirement withdrawal strategies should be personalized, not one-size-fits-all. Why you don't need a high income to start? A common misconception is that only people with a high income can begin financial planning, but that's simply not the case. In fact, financial experts like Dave Ramsey and organizations, such as the National Endowment for Financial Education, emphasize that the earlier you start, the better, no matter your income level. Even if you're earning a modest salary, setting aside just a small portion of it every month can lead to big rewards over time. A 2022 study by the Wall Street Journal revealed that individuals who started saving with just $100 a month, even in their 30s, saw substantial growth due to compound interest. The key is consistency and smart budgeting. By prioritizing goals like building an emergency fund, paying off high-interest debt, and investing in low-cost index funds, anyone can create a solid financial future. It's not about how much you earn, but about making those small, smart choices that add up over time. The best time to start financial planning is now, no matter your income. Understanding its role in dispelling related myths. Diversification is often hailed as a foolproof strategy to protect investments, but many misunderstand its true purpose. The myth is that diversifying means simply spreading your money across various stocks. In reality, it involves mixing different types of assets, like stocks, bonds, real estate, and even commodities. According to a 2023 report by Vanguard, a well-diversified portfolio can reduce risk significantly while providing steady returns over the long term. One of the biggest misconceptions is that diversification guarantees profits, but it's more about minimizing losses during market downturns. In 2022, the Financial Times highlighted how investors who diversify their portfolios across asset classes, instead of focusing solely on stocks, fared much better during times of economic uncertainty. Remember, diversification isn't about avoiding risk completely, it's about managing it. So before you dive into any investment, make sure you're spreading your money across different types of assets to balance potential risks and rewards. Behavioral biases. Investing isn't just about numbers. It's also about human psychology. Many investors unknowingly fall into cognitive traps that can cost them dearly. One of the most common biases is loss aversion, where people fear losses more than they value gains. In 2021, a study by the Journal of Behavioral Finance revealed that loss aversion leads many to hold on to losing investments for too long, hoping they'll bounce back. Another pitfall is overconfidence, where investors believe they can predict market movements. A 2022 report by BlackRock found that overconfident investors are more likely to make risky decisions. The key to overcoming these biases is awareness. By educating yourself and sticking to a disciplined investment strategy, you can minimize the influence of emotions on your decisions. In fact, research by Morningstar in 2023 showed that investors who regularly rebalance their portfolios are less likely to fall prey to these biases. So recognize your emotional triggers and stay focused on long-term goals to improve your investment outcomes. Financial myths in the digital age. In today's digital age, misinformation about personal finance spreads quickly. From social media influencers to unverified online articles, it's easy to fall for myths that can harm your finances. A 2023 study by Pew Research found that 60% of people rely on the internet for financial advice, yet many of those sources lack credibility. It's crucial to verify financial information from trusted experts or institutions like the SEC or Fidelity. Just because something sounds good online doesn't mean it's true. Critical thinking and fact-checking are essential for navigating financial advice in the digital world. Feeling left behind? Don't worry, you're not alone. Many are missing out on key financial strategies. Stay ahead of the game by subscribing to our channel for expert tips. Next up, we'll dive into navigating the global economy, investment strategies for volatile markets, an essential guide you won't want to miss. Hit that subscribe button now and stay in the know.